And with that, maybe I'll kick it off. So thank you everyone for attending this webinar. I know folks have been on Zoom calls and webinars nonstop over the past couple months, and really appreciate you attending this one. I think it's very important as it pertains to the Opportunity Zones marketplace and where we're at as an emerging industry. Just want to take care of some quick housekeeping real quick. We are recording, just to let you know, and the recording will be provided afterwards. We will email it to you, but also we will do our traditional blog post where we will include this in that blog post. So this will be available for your enjoyment into the future. Today, I am joined by my colleagues at EIG, Chris Slevin and Catherine Lyons, and they are actually going to kick us off. But before we do that, I want to mention, number one, if you have questions throughout the presentation, please submit them through the Q&A box. And number two, I want to go over the agenda real quick before I hand it over to Chris. You can go to the next slide. So today what we'll be talking about is we'll be doing some level setting. So state of the OZ marketplace prior to the pandemic, where we were at coming into the economic condition under which the survey was taken. We'll talk a little bit about the survey process and the respondents, different market segmentations and where they weighed in most heavily. And then we'll talk about survey results. So for those who took the survey, we will basically go through the results from each question that was asked. We'll provide a high-level overview of our key findings at the top, and then go through basically continuing from there. And then at the end, we will sort of wrap up in summation based on what we saw with the survey results, our best effort at surmising where the OZ marketplace goes from here, what activities need to happen, as well as whether or not the marketplace is positioned to be a good partner or agent of the economic recovery. And I'm kind of giving it away a little bit here, but we think they may be. So we will also provide time for Q&A. So again, if you want to submit questions, it's in that Q&A function at the bottom of your screen. And with that, I will turn it over to Chris Slevin.
Thanks, Rachel. Make sure I'm off mute. Thanks, Rachel, Catherine. Thanks everybody for joining us today. You know, at EIG, we have the benefit of interacting with a real broad set of stakeholders in the Opportunity Zone space. And we learn a lot from everybody. And so I describe us sometimes as a nerve center for the kinds of activity, both on the sort of policy side and the regulatory side, but also in the market. And so it's for us a real benefit of getting to learn from you all as this market stands itself up. So thanks for your continued engagement with us, and thanks for your participation and help with this survey. Why don't we go to the next slide? So the marketplace began to hit its stride really late in 2019. Why was this? Regulatory clarity, certainly a factor. Treasury released final regulations in late 2019 in December. So fundamental questions around investing in operating businesses were clarified, among other questions. I think just as important, you know, the network effect began to take hold more. There was a comfort level among committed fund managers, investors. Communities, I think, had more of a firmer grasp as to what opportunity zones are versus what they're not. And so these are all signals of a more maturing market. And so info from our friends at Novogradac indicated a real uptick in investment activity beginning, you know, really the third and fourth quarters of 2019. Again, likely aided by clarity in the regulations. You know, without any kind of required information about fund reporting, this is a useful proxy for market activity. It is based on a voluntary survey of funds, so it is by no means the whole picture, but it does provide a useful proxy. So really in October 2019, you began to see a real uptick. And in April, by then, an estimated 10 billion in opportunity funds have been raised, actually in hand. So, before the pandemic hit, the expectation was for real continued growth and activity in 2020. This was, of course, dramatically disrupted by COVID. And it raised new questions as to what are the near-term effects and long-term effects of the pandemic on the OZ market. So we wanted to conduct this survey, and it's an important period in the early life of this incentive. Again, with the regulations finalized, with the more mature set of stakeholders, more establishing of norms. So we wanted to gain insights from practitioners like you into how to begin to look at the incentive in the context of the economic crisis from the pandemic. This is still a very new policy tool, and its origins are really rooted in lessons from the last recovery from a financial crisis, where we didn't have a tool like this to deploy. So I think this survey begins to hopefully point us in a direction of what's needed, both from investors and stakeholders, what we need from Congress, in terms of further shaping opportunity zones to meet the moment we're in, and what we need from state and local policymakers as well. So EIG asked survey participants to describe the effect recent conditions have had on transactions and investor behavior, to begin to provide those insights as to whether their level of engagement was waning as a result of the crisis. To provide their perspective on the future of the marketplace, as well as ways Congress can help ensure that the policy meets its intended goals. Why don't we go to the next slide? So EIG analyzed responses submitted from 108 stakeholders across multiple categories, including OZ investors, fund managers, and businesses, service providers facilitating transactions, and also local opportunity zone coordinators on the ground, charged by their communities, by their cities or states, with implementing community-driven OZ strategies. 31% of respondents have a national opportunity zone footprint, and 69% were focused on more of a regional strategy. 45 fund managers participated in the survey, which represents the largest respondent group. If you go to the next slide. So key findings, without any surprise, recent conditions had a chilling effect on the marketplace. 52% reported that the crisis had a negative impact on OZ activities. I think we thought this actually could have been a higher number. 48%, I guess, said that there was either positive or sort of neutral or no effect. So yeah, we're not surprised that 52%, but actually thought it could be even higher than that. Investors are waiting for signs of stability prior to making decisions. I think that's across the board. The crisis has affected the work of stakeholders in varying ways. I think Rachel and Catherine could get into this more, but everything from the public sector side and waiting on permitting issues, for instance, to just on the bank side and waiting on just decision making in financial institutions. A majority do remain optimistic about the future of the marketplace. And that a lot hinges on how government responds and in the near term, and whether Congress extends the investment deadline before beyond 2026, as well as address other fundamental policy issues with the program. So I'll pause there, and at this point hand it over to Catherine Lyons.
Chris. So we can go to the next slide. We'll start to dig into some of these key findings just a little bit deeper. So we'll start with the current market conditions. Chris gave a nice overview of kind of where we were at prior to the pandemic. But one of the first kind of baselining questions we asked in the survey is related to kind of what the kind of current market conditions are right now, and what, you know, various sectors of the market are feeling. And so, you know, to Chris's point, we did kind of anticipate that there would be likely a, you know, given the continued level of uncertainty, that there could have been a much kind of higher negative effect or impact. But instead, we're seeing that about 24% have said that they, you know, feel positive or very positive even impacts on their OZ activities. You know, one item of note, although we do want to kind of make sure that the kind of sample size here was a lot lower, but the QOZB, so the Qualified Opportunity Zone business owner, while there were only 6 respondents that fell into that category, did feel about 50% said they felt negative impacts from that. And I think that maybe just is indicative of how small businesses and businesses across the economy are feeling right now, again, as temporary closures are in place, as uncertainty kind of continues, even though we are starting to see some of those closures kind of or restrictions lift, and that may you know, certainly impact you know, how survey respondents may respond, you know, now or even in the future, certainly. So anyway, but this is kind of broken out by market sector here, and with fund managers, of course, being the kind of top the highest number of respondents that we got within the sector. And you can see here that they're generally feeling pretty positive about the impact of their investments. So we'll go to the next slide. Yeah, so digging in here a little bit more to investor behavior. So, you know, I think as the whole here, investor behavior signals kind of positive long-term prospects for investments in opportunity zones. You know, you can see here, 71% of prospective investors remain interested, but maybe currently hesitant to commit. You know, again, I think that that's probably market-wide in terms of uncertainty and sort of you know, wanting liquidity and sort of that flexibility within the market just to be as responsive as possible to changing circumstances, which certainly are kind of rapidly shifting. But 48% also said that investors are actively looking for opportunities to place their capital in the OZ market. So just to temper that a little bit, you know, 1 in 4 respondents reported that previously interested OZ investors decided against entering the market. So those are ones that were kind of prospective and hadn't yet entered, but are and may be, you know, a quarter of them are sort of rethinking some of that that initial strategy. Another kind of item of note, I think, is that 38% of fund managers plan to deploy their capital on schedule at the time that they did take the survey as well. So the level of disruption, again, maybe less so than we would have initially thought prior to releasing that and seeing these results. Next slide. So continuing on this thread. So, you know, 45% of respondents have said that the investment process has been interrupted due to disruptions in daily operations. And I think this is kind of what Chris was alluding to. You know, those we've spoken to kind of anecdotally, and I think that the survey responses certainly validate this, is that you know, the ability to kind of get deals done, to perform due diligence, to travel to you know, the locations of these investments and these projects, or even to get approval from, you know, various government entities, has certainly been disrupted by the inability to travel and to meet in person, things like that, and that's definitely, you know, being borne out. And then about two thirds of investors are waiting until the market has regained some sort of certainty or stability as well, before kind of determining their next steps and strategy too. So I think with that, we can go to the next slide, and I will turn it over to my colleague Rachel again to take us through OZ activity over the coming year.
Yeah, thanks, Catherine. And I'm going to pivot us a little bit, because the information that Catherine just shared very much represents a moment in time, right? So the respondents took this survey. They had a week period starting on May 18th. And so just wanted to give you that information. A lot of you took the survey, so you know it, but the market's changed even since then. And we've heard as recently as this morning that there's been increased activity. Investors are a little bit more optimistic given the rally in the stock market. And so what I want to do is shift us into how folks responded about activity over the coming year. So if that was how the onset of the pandemic impacted their current OZ activities and how investors were behaving in that moment, we also asked folks to talk about the activity over the coming year. So make those future-looking projections, forward-looking projections. 56% of respondents reported that their level of engagement with OZs would remain undiminished or may even increase over the year ahead. And that may even increase is really interesting to us. It's encouraging. And I also think that what this shows is that we can probably anticipate some shifts in the marketplace over the coming year as some folks step back from OZ engagement and others double down or ramp up activity either opportunistically or in response to the current economic situation, seeing their role in economic recovery. Really interestingly, 37% reported that the crisis has forced them to make a significant change to their core OZ strategies. And so again, you're seeing a little bit of a pivot or a change in strategy, which may have to do with sources of funding. It may have to do with investor base or different assets that they're investing in. But again, 37% said that they anticipate a change in strategy, and 30% said that it's uncertain. So you can still see a little bit of folks trying to feel out what's currently happening in the marketplace before making that pivot or moving forward. It was really interesting. Nearly half of fund managers and real estate sponsors said that their current strategy is really well positioned for the current environment. So that they feel strongly that their either engagement or their strategy will not change because they have already positioned themselves well in the marketplace. And fund managers especially were amongst the least likely to say that they're stepping back. So I think we can anticipate continued engagement from fund managers. Next slide. So this is a hefty chart to look at, but I want to point out a few things. The impetus behind this chart and this question was, if we first asked, do you anticipate decreasing activity? Then of course we wanted to know, based on your response, what were the different issues that were most likely to influence that behavior? And this was a question, if folks don't remember, where you could select up to 3 priority issue areas. And so of course these don't add up to 100, but it does represent sort of top tier priorities. Again, you see there, a lot of folks, 42%, say that their strategy is well suited for the current environment. This next point really continues to come up, where 40% indicated that their strategy is dependent upon the availability in terms of other sources of financing. And I think that that probably resonates with all of us really well, just given our familiarity with the capital stacks of OZ deals. OZ is rarely the only source of financing into a business or into a project. And so of course, if the other sources of financing are in any way impaired or not made available, then that is going to have a likely impact on the OZ strategy. We're hearing it both on the debt side as well as the public sector subsidy and other sources of financing side. Important to also acknowledge that 23% said sustained closures are impeding daily operations and creating harmful market uncertainty. Again, I think that that represents this sort of point in time survey where a lot of those closures have been lifted or relaxed. And so maybe not so much of an issue right now, but if there's a reemergence of those towards the end of the year, just something for us all to pay attention to. Some more interesting findings here that I want to point out. At the very bottom there, 6% or 5.6% of respondents said that their OZ strategy is concentrated in an asset class, which will be or has been disproportionately affected. And, you know, I take that to be a good sign that not that many folks really feel like their focus or their area of focus of investment is going to be negatively impacted, or that they are able to sort of diversify the assets that they're investing in and won't be overly burdened by the current economic condition. You can also see that 16.7% of folks said that their investments in their OZ portfolio or their pipeline are at risk of being financially impaired. I think that, again, marking it to what's currently happening in the overall capital markets and the investment portfolios of everyone, this is a very, very low response percentage-wise, and so something for us all to be encouraged by. Yeah, I think I'll probably leave it there, except for to note my original investment assumptions are no longer valid and transactions need to be restructured. 13.9%. You know, this could go either way. I think that a lot of folks need to restructure transactions either because a partner maybe is no longer at the table, or a source of financing has been altered or is no longer available. But we're also hearing that pricing has been reduced, which is helping to achieve higher rates of return on OZ investments. And so restructured can be a number of things, but I take that to be more of a negative than a positive, but just wanted to note that as well. A small negative of 13.9% negative. All right, next slide. And so moving, you know, beyond the year ahead, just what is the general sentiment? What is the outlook for the OZ marketplace? Chris mentioned at the top, 58% or the majority of respondents report general optimism about the future of the marketplace. What we heard earlier today is that number may even be increased now if folks were taking the survey today, just based on investor response, as well as deals moving forward that had been stalled. Only seeing 15% that are actively pessimistic. And there's, you know, at the time the survey was taken, there was still, you know, a good amount of uncertainty, about a quarter of respondents, which I think is to be expected based on that moment in time. But overall, I think that, that this is a pretty positive response here. Good, next slide. And so this was the last question on the survey. So this question was phrased as, what action should the federal government take to ensure that opportunity zones is an effective tool for economic recovery? There was this overwhelming response around needing to extend the investment deadline beyond 2026, which I don't think surprises most on the phone, but I think it was interesting that even within the different segmentations of respondents, it was a very clear choice for folks. So 86% of the investors that were surveyed, 67% of fund managers, 73% of the real estate project sponsors. Those were the top three within that category, but people really, you know, coming out strong with an opinion on this one piece. Another notable finding here was that right around 45 and 44% equally, 45% enhance the value of the OZ incentive, 44% enact new tax benefits for small businesses and OZs, prioritizing QOZBs. I think that response probably had a lot to do with the current state of businesses and needing to address liquidity and solvency issues, as well as looking for other policy solutions to help encourage additional market formation and traction around investment into opportunity zone businesses. What I would like to note, though, it was very encouraging that half of the respondents taking the survey, even though it may be aspirational in nature, they did note that entrepreneurship was a focus, as well as operating business investments. So that was half of the respondents. And then here you'll see 26% have said that the government needs to fund local capacity building and technical support efforts in opportunity zones, which I think makes a lot of sense because given where we're seeing really strong results with opportunity zone investments and building a pipeline, where it is very much led by the community. You have folks on the ground building those ecosystems. You have local leaders working with anchor institutions and conducting investor outreach and engaging them. And so that all requires funding in order to get that done. So that makes a lot of sense that that came through like that, as well as the technical support efforts. And, that could be technical assistance to small businesses or to businesses that are looking to access opportunity zone capital and helping get them to the table and connected to investors. And then here, 37% responded provide economic development assistance directly to state and local governments. I would imagine that that has a lot to do with shoring up local economies, ensuring that cities and regions remain investable, quote unquote. We heard that phrase a lot at the beginning of the market. And also to ensure that where there were deals that were being structured that included sources of public sector financing, that those wouldn't be impaired in any way or fall apart, and that the potential for those moving forward would still be available. Final slide. So where do we go from here? As Catherine and Chris noted, there was, moment in time negative impact on the UZI marketplace. We refer to it as a chilling effect because it was 52%, so just over half. But it did, as Chris mentioned, impact different stakeholders in varying ways. But the message came through that it was delaying investment. And that uncertainty had sort of taken over, but there is what we see really this underlying resiliency of the marketplace, and it's especially encouraging just given the nature of the marketplace being so young, being that it's still in formation, and we really hope that the momentum that we saw coming into 2020, if it hasn't already, will actualize itself once again after this brief moment of hesitancy or pause. I think, as we all know, UZI residents are disproportionately likely to bear the brunt of COVID-19 crisis, both on the public health front as well as economic conditions. And that's the reason why many of us are involved in this marketplace in the first place, is to support those communities, support those residents. And we are on the ground, or we're in contact with them and groups that are serving them, and we know that this has had a disproportionate effect. And so I think while many are seeing opportunities within a framework of crisis, and a way to make their UZI activities really resonate within the communities that they're serving and on the ground, and to strengthen broader economic recovery efforts in general. That is very encouraging, and that is something that we would love to continue to see happen. But again, as Chris noted at the top, the responses that we received really indicated that in order to harness that enthusiasm, harness the continued momentum, indicated by that 58% optimistic outlook for the future response that we got, it's really going to take action from government. And we already saw Treasury come through with guidance earlier this month that provided emergency regulatory relief and extended some key deadlines to help encourage investors to remain at the table. And that was obviously very helpful, but now Congress really should take action to strengthen the policy. Key amongst that would be, and I think it happens in tandem, but reporting requirements still remain a key priority for all stakeholders that we continue to speak with. So reporting requirements and transparency, as well as extending that 2026 deadline, that seems to be a priority across the board. And I think that the survey response really helps to underscore and ground truth what we're hearing from our fellow policymakers. And with that, I'm going to turn it back over to Catherine, and I think we are open for Q&A.
Yeah, thanks, Rachel. We are indeed. So please submit your questions via the Q&A box. Don't see any yet, so as we're waiting for those to come in, I just want to point out some resources that EIG has published that we hope will be helpful to your Opportunity Zones work. The first is our OZ activity map, which is really a kind of a cross-section of investments, funds, and initiatives all across the country. Really highlighting kind of the diversity and particularly those that are have a real kind of community mindedness in their strategy. So it's not a comprehensive look at everything going on across the country, but we think it's you know, ones that are worth kind of showcasing as we continue to develop and see kind of emerging market norms here. We have a really robust OZ resource center as well, and our OZ survey blog post that has all of these findings and more went live at 3 o'clock upon the start of this webinar, I think, as Rachel mentioned earlier. So you can see that officially on our website and dig in a little bit deeper to some of the findings that we've just gone over over the last half hour or so. Additionally, the White House Opportunity and Revitalization Council, which I believe is made up of about 13 agencies, all kind of tasked with both the successful implementation of opportunity zones, but generally just really a focus on, you know, kind of improving the outcomes within distressed communities. They have put out a couple of opportunity zone specific reports lately. One, a best practices report, that really highlights some best practices across a range of sectors in the market. And then as well as a community toolkit, the second volume as a kind of precursor or as a, the next phase of what was released, I believe, last year. So with that, I see at least one question come through. This is related to additional legislation. References a bill that off the top of my head, I'm not familiar with, but of bills that may open additional sources of capital to come into the OZ marketplace. So I don't know if there's a question there, but just generally, like, what are we seeing? Maybe this is an opportunity to talk about like what we're seeing in Congress around opportunity zones, and maybe talk a little bit more about some of our priorities there. So I believe there's a couple more questions. And so Chris, maybe while I'm fielding those, do you want to take that?
Yes, thanks. I guess the way we'd see things, and even starting pre-COVID pandemic, there are some fundamental issues related to opportunity zones that needed to be course corrected through legislation. Top on our list for that is require data collection and greater transparency. We need objective data to see how the incentive is working. There's a few different bills that have been introduced in Congress to try to achieve that. We at EIG have favored the Impact Act introduced in the Senate by Tim Scott late last year, I believe, with a handful of other senators. We think that's a great foundation to work from, and that it actually goes far and beyond in terms of how to measure what the incentive's doing in census tracts and comparing that in lots of different ways. So we think that that's sort of the foundation, but there's, I think, an open discussion, I'd say, as to what's additive to that, ranging from sort of extending the timeline for investments to learning lessons from the early market and providing greater technical assistance and capacity building in communities. We know, and I think a number of folks on this call can attest to this more directly, but when there is either a full-time employee or a nonprofit or a group that is, or an individual even, that is responsible for harnessing various stakeholders and to have a real community-driven process to interface with investors and backed by local leadership, that just makes for a more inclusive process and a more impactful outcome in terms of the investment and hopefully over time and the outcomes we all want to see in low-income communities. So I think that there's a lot of interest in how to deploy more resources in opportunity zones or just low-income communities generally A number of other ideas are just been introduced and out there. I can't rattle them all off, but I consider those sort of additive to some of the fundamental issues around reporting and data collection that are just need to get done.
Yeah, thanks. See a couple more in the Q&A, but I'm going to start with the ones that are submitted via the chat box related to what Treasury has already done related to COVID, what you see is likely next. So as Rachel mentioned on the last slide, Treasury submitted, or rather released guidance that extended some real key timelines and provided relief for some opportunity zone investments and funds, particularly those that were maybe up against timelines like for example, the June 30th timeline that many funds would have to prove that 90% of their capital was deployed into qualified investments and assets. That's usually a kind of a 6th month. So at the June 30th and then again at the end of the year, funds have those testing dates. And of course, for all the reasons we kind of mentioned earlier at the top of the webinar, that's been difficult to do, at least we've heard anecdotally, because of some of the delays in proper due diligence and meetings and things like that. So, Treasury has kind of extended, or really provided relief for those types of testing dates. They've also provided some additional time to meet the substantial improvement test, for example, and for investors that have realized capital gains and would have had to put them into opportunity funds within a certain time frame. They now have, I believe, till the end of the year to do that. That came out from Treasury earlier this month. I think overall was really well received by by the overall market and the investor and fund manager community. They can breathe a little bit more of a sigh of relief to kind of get that hopefully additional certainty as we and stability within the market overall and the economy overall. That will hopefully, as Rachel said, that's already kind of happening. And hopefully that trend will continue and will allow for a little bit extra time for these funds to kind of properly deploy their capital in that sense. So that's what Treasury has done. I don't believe we'll be expecting any specific additional guidance, of course, unless circumstances continue to shift around the pandemic and how it impacts the economy. But at this point, we sent a letter to Treasury and IRS on this point back in April. We know several of our kind of key partners did as well, including our congressional leaders and champions, Senator Scott and Representatives Kind and Kelly in the House as well. And I think the guidance really answered the main questions there and the main issues. So I think it was pretty comprehensive in its scope. There's another question, and I think Chris may have kind of drawn on this and may have answered it to the extent possible, but related to kind of Congress's reforms in response to COVID, and will they make a difference in the long-term viability and value of the OZ program? And I definitely think that the extension out, if Congress is considering that, which we certainly know that they are, in tandem with a few of the other policy changes Chris mentioned, that extending out till 2027, 2028 would certainly, I think, be very valuable to investors. And I think, of course, a survey and the fact that the vast majority of I think 64%, right, Rachel, said that that would be really helpful in their strategy, I think indicates that. It certainly adds a kind of a level of value to the incentive. So hopefully that answers and addresses that question. And of course, Rachel and Chris, add anything if you have additional items there. Great. So there's one question here related to the SEC's accredited investor definition on those authorized to invest in opportunity funds. Sorry, just reading this paragraph here. Detailed questions, we like those. So I'm less familiar with that. Rachel, I don't know if you have any thoughts, but that might be something that we can follow up with you separately afterward and dig into a little bit more on that particular question. It's just it's an area I'm less familiar with, but Rachel, if you want to try to add that, that'd be great.
Yeah, I mean, I would want to look into it, as Catherine mentioned, but to my knowledge, there's nothing that prohibits a retail investor from investing into an opportunity fund as long as they have qualified gains to do that with. The problem is that a lot of retail investors, number one, don't have access to the network of fund managers, or more likely, they don't have access to capital gains because they're not investing or they're not within that class of investors. And so I don't know what they did specifically to opportunity funds, but worth looking into. They may have changed their definition for accredited investors in general and not targeted to opportunity funds. Any additional information you'd like to provide here, please do.
Thanks. And that's all the questions that we've received thus far. If you have any more, feel free to continue to add them in the Q&A. We'll read them from the chat too. It's no problem. Catherine,
I am seeing one here about investments into rural opportunity zones, and whether any of the potential congressional reforms may, or additional capital coming out of relief packages could potentially be targeted to rural communities, or in any way help to address some of the IRR issues that folks note about making investments in rural communities. If you want to give the take from a legislative standpoint, I can also talk a little bit about the marketplace.
Yeah, I'm sorry, I'm not seeing that question, but why don't you, let me try to find it so I can properly respond. But if you want to start off with the market, that'd be great.
Yeah, so obviously, well, again, I don't think it's going to be a surprise to folks on the call, but it has been a little bit more difficult to try to get investment into rural communities. And the person who's provided the question has said one of the reasons is that investors, it says investors don't see enough benefit on the proposed project to bring it over the line. It's useful, but it's not crucial. And so wondering whether or not any of the reforms would address that. From a market standpoint, I think it's the most powerful where you're able to tap into local capital and leverage the capital gains of local residents. Again, that doesn't address the IRA issue, but we are seeing that in rural communities that is really powerful. And also the idea of being able to have better pricing out in rural communities sometimes can be helpful for investors. It sounds like you have very direct experiences with certain investors that say it doesn't pencil. I would kick the tires on their structuring assumptions. They may be assuming certain things based on perceived risk or use of the property that you would potentially look at differently. And so they're adding a premium to some of their pricing assumptions, which then means that the bottom line profit margin isn't working out for them, or bottom line margin as it pertains to IRR. I don't know if that made sense, but I would just push back on their underwriting assumptions a little bit more.
Yeah, and to kind of follow up on the maybe legislative piece of this, and I think also what the survey bore out a little bit as well with regards to additional funding or assistance for more local capacity building, and maybe even pre-development type capital, things like that at the local level. I mean, I think that is certainly an area that would particularly benefit smaller communities, that may not have as many of the kind of internal resources to, attract the capital and kind of help structure some of these deals from a kind of public sector perspective. And so that may be an area that would particularly impact or assist in some of these smaller communities as well, where they don't have the kind of chief opportunity zone officers or others as we're seeing in as established in some of the larger, more urban environments.
Yeah, and Catherine, there's another question here that says it seems OZBs were more negative in the survey than fund managers. Could that be because OZBs are not closing the investments they were hoping for? And the OZBs that ultimately responded, I think the majority of them were in some stage of capital raise or some stage of not capital raise, but trying to access capital from fund managers. And so it may be, in a lot of the responses that we saw around stepping back from the marketplace could be reflective of that as well. But it may be that just given the current market conditions, either the hesitancy amongst investors wasn't going to work with their timeline as far as when they needed investment into their business or into their project. And so they had to move on, and that could be one reason, or just that the underwriting assumptions didn't work. But I do think that there can be a one-off nature of OZ involvement with OZBs as opposed to fund managers who are seeing higher deal flow.
And not to discount that finding by any means, but I do think it's worth noting that the sample size for both of those were quite different. The QOZBs, I think there were 6 versus about 45 fund managers. So I just want to caveat that a little bit and the weight of that particular finding too. But of course, everything that Rachel said also is important as well. Those are, oh, sorry, one more. Thank you, Trickland. So the last one I see here, so opportunity funds could provide capital liquidity for opportunity zone-based businesses and properties without adding debt to balance sheets. However, owners would have to reduce their equity stake to no more than 20%. Allowing opportunity funds to invest in opportunity zones-based businesses and properties without requiring them to relinquish their minority ownership is something they've worked hard to build. So it's kind of a recommendation in the kind of 20% rule here, without having them to relinquish their minority ownership in something they've worked hard to build, would provide vitally important equity for entrepreneurs, family-owned businesses, and property owners. And I believe that's related. That's kind of the related party issue, I believe, too. The 20% is the kind of related party threshold. So just kind of adding that additional context there. But thank you for that recommendation as well.
One of the encouraging models that we've seen to address family-owned or legacy businesses, and it doesn't quite get to the ultimate outcome that is being proposed here, which we understand, but is where you have a family-owned business or a legacy business that is willing to cash out of that business, realize some appreciation, but they don't necessarily want to hand over any sort of full decision making, or they still want to be involved in some way because it is a business that they've built. We're seeing models where the Opportunity Zone Fund basically acquires them, and then at the beginning during the transaction period, there are it's negotiated that those folks, the business owners, come on board in some ownership way or some management way, so that they can continue to guide the direction of the business, even though they're not the owners of the business. And they can even make investments to support the value creation of that business, and sometime, or the value created by that business into the future, although it may not be tax advantaged.
Okay, that's all the questions I see currently in both the chat box and the Q&A. So maybe we'll give folks about 30 more seconds to submit any final questions. Otherwise, we can maybe end with some closing remarks. All right, just a reminder too, while we're seeing if anyone wants to submit any additional questions to consider, the reminder that the blog is up on our website. We will be circulating also a recording of this webinar along with the blog and other materials related to the survey after this. Of course, a big thanks all of you for taking the survey. We could not have done it without you, and we really appreciate you sharing your perspectives and insights, as we were and remain within this kind of economic crisis, and really are glad to see the overall kind of positivity and optimism for how opportunity zones can hopefully really be a impactful tool for the recovery. Seeing no other questions submitted, Rachel, unless you have another a closing remark, I think we can wrap up.
Yeah, the only other thing I'll say is I also know that we have some distribution partners on the webinar, and as Catherine mentioned, can't do it without you guys. So thank you. We hope this information has been helpful. And I'm actually going to kick it to Chris to close if there's anything Chris wants to say.
No, not that it hasn't already been said, but thanks again to folks for participating today and for your work in helping us get the survey out. And look forward to continuing to engage with you.
All right. Thanks, everyone.
Thank you.
Bye-bye.